Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He is a hedge fund manager. He's founder of Myrmikan Capital, and he runs the Myrmikan Gold Fund. He's also the president of the Committee for Monetary Research and Education. Dan Oliver, thank you for joining me.
Thanks for having me.
Now, Dan, I want to get your background because our listeners might not be familiar with you, but I saw your interview on Real Vision TV a month or so ago. It was very interesting. How did you find the Austrian School of Economics? What got you interested in gold? Are you a glutton for punishment?
Well, it's interesting. I had a standard education. I went to Columbia Law School in INSEAD, standard MBA, JD programs. And of course, they teach you the world according to Keynes. And since there's no alternate theory presented, you just sort of accept it as a very twisted thing that's beyond your comprehension. You move on to more practical matters, and sort of that's how I reacted. And also, my view towards gold was sort of the Warren Buffett view, which is it doesn't produce anything and it's sort of useless, and what's the point? And who cares? And so I very much had that mindset going through my education and my early work experience. I was invited to go work down in Buenos Aires in the commodities industry in 2007, and people who aren't in the industry might forget that though the economy started rolling over in '07 in advanced economies, the commodity markets went vertically higher through '08. And it was the last party going, and then in '08 it utterly collapsed over a 4-month period. And certainly living through that as a novice in the space was a very educational event. And it was coming out of that I started reading economic history and trying to figure out what I had lived through, what I'd seen firsthand in the epicenter of this commodity bubble. And it led me to books I read written during the 1930s, not about the Great Depression, but during the Great Depression. And I realized the things I was reading were absolutely no different than the things I had just lived through. And it was just completely fortuitous after reading some of those books that I opened a book on Hayek, actually, which I'd never read. Of course, I knew about Hayek, but no one had ever assigned me his books, so I had never read them. And an obituary for von Mises fell out of the dust jacket in my parents' library, and I'd never heard of the guy, but I read the obituary. I thought, this is interesting. So I started reading von Mises' books, and again, it was just, he died in the early '70s. He'd written about things that had happened decades and decades earlier, and you start reading it and having lived through a commodity cycle on the inside. This is it. This explains how the world works, and so all of a sudden it was the practical elements of it, not the theoretical. I mean, it's there, of course, but it was the fact that it's described my practical experience so well that I just this was obviously how the world works. And the rest is sort of history. I started reading more and more of those sorts of books. I'm actually working right now on a history of credit bubbles, looking at the world through that lens. You can trace credit bubbles back, into Mesopotamia. They've been around for 4,000 or 5,000 years. So there's really nothing new that we're living through. Though the Keynesians sometimes like to pretend it is. They say that Marxists and Keynesians alike pretend that modernity is somehow different in kind than the ancient world, than what happened before the general theory came up. But of course, that's nonsense. And that's when one looks at history, that's what one sees, is these cycles have been going on in a well-documented fashion for hundreds of years, and in an anecdotal fashion for thousands. So that's how I got really hooked on this topic. And of course, in that survey, one starts to learn about the fundamental role of gold, not just in the monetary system, but that underlies a civil society. And how important sound money is to building wealth and to keeping culture and society alive. And so I became very involved in the CMRE, the Committee for Monetary Research and Education, which was a group founded by Henry Hazlitt and friends back in 1970. And it also led me to the gold space and prompted me to start my own gold fund in 2010.
It looks like, it sounds like that you had an epiphany, a journey, awakening journey, somewhat similar to mine, where I was a stockbroker during the 2008 financial crisis. I didn't believe the answers that I was hearing from the talking heads on the mainstream financial media, Ben Bernanke at the time, Alan Greenspan, before he left the Federal Reserve, and I just didn't believe a lot of what they were saying. It didn't make any sense. I heard Peter Schiff. I started reading the Austrian School of Economics, and now you do Myrmikan research, and it chronicles the collapse of the current global credit bubble, the largest and broadest in history, analyzing current events from the perspective of Austrian economics and placing them in a historical context. I think that's important to go back and learn from history. You know, one thing, I've read books about, you know, these history of credit bubbles. I was actually surprised to learn that credit was actually invented before money was. So if you were in a local tribe or town, before they actually, you know, had decided on money, you could have credit with a merchant in trade or something like that, and you know, you would have to pay the guy back in barter or other things. So there's actually credit before the marketplace decided on money. But you know, over that time period, the market decided that gold and silver were two of the best forms of money, although now we just have, you know, counterfeiters in chief at all the different central banks.
No, that's very true. One of the most interesting anecdotes that I came across in my research, it was the Panic of AD 33, which I'd never heard of course, but the ancient Rome had a money panic, and it's described very in detail by Tacitus, in the first century historian, and he talks about how there was a panic in the money market, and the Emperor Tiberius took 100 million sesterces out of the imperial treasury and lent it to the banks at no interest for 3 years against real estate collateral. And you think to yourself, you know, why did Hank Paulson never give the Emperor Tiberius credit for his TARP program? And TARP was precisely exactly the same thing. Now there aren't neat price series to look at in Tacitus, but that story is the same. And again, you read that story happening over and over and over again, and it's why, beyond the theory, it so convinces me that this is in fact how the world works. And if that is how the world works, and I think it's pretty clear it is, it also implies that the current system that we are living in is, as I say and write, it is the largest credit bubble the world has ever seen. And what that means, of course, is that its collapse will be the worst in history. It doesn't mean civilization will end, but it does mean that there's going to be severe economic dislocation when that happens. And you know, what I'm trying to do is be on the right side of that. Although I think, you know, society will suffer, but hopefully we come out of it with civilization intact. I mean, I am an optimist in the long term, believe it or not. But I do think that in the short term, we're going to have major political and economic challenges.
I agree. I think there's going to be a lot more volatility going forward, but as an Austrian school economist, I would say, you know, there's really unprecedented in historical terms. There's been trillions of misallocated capital in, you know, artificial money and credit created out of thin air by global central banks. You know, it's not just the Federal Reserve doing it. We have the Bank of Japan, we have the European Central Bank, the People's Bank of China. So basically, you know, it's just unprecedented. Over 18 trillion in artificial money and credit created out of thin air since the 2008 financial crisis to basically keep asset prices propped up. That's general stocks, bonds, real estate, and that's not even talking about the credit bubbles in the real economy, whether it's student loan debt, whether it's subprime auto loans. You know, I could go on and on and on about this, but you were talking, you sent me a paper a couple weeks ago about the relationship or correlation between rising rates and market crashes. Do you think the central banks are starting to get aware that there's bubbles all around them, that they've inflated all these bubbles and that they want to let the air out and maybe let asset prices fall?
Yeah, well, I look at the world a little bit differently, just to be clear how I see it. I don't think the central banks actually create the bubbles. I think what creates the bubbles is the fracture of banking system. And we know this because there were bubbles blown in the 19th century, and then they would collapse of their own weight. And because there was no central bank, that collapse would return asset values and capital allocation to sensible places. And that's why the 19th century was such a productive era. I mean, it would have been more productive without the panics, but the panics were useful to return capital to even keel. And remember, the function of the central bank, the purpose of it, was to forestall the panic. And so it's not that the central banks, in my view, cause the bubble. What they cause is the inability of the market to clear these bubbles, and it allows the really nefarious players, who are the big banks of the world, to keep inflating the credit supply into absurd levels, and that's where we are now, right? I mean, the QE programs, it wasn't dropping money on helicopters to people; it was giving banks reserves to go give more loans to people who probably shouldn't take them in the first place, and so that's where we are now, and it's why even places like the Bank of International Settlements is aware that the credit misallocation is worse now than it was in 2007, and so. If you look at the history of, especially the Federal Reserve of the past century, it's been a very clear pattern, which is that they prevent banks from liquidating, which is what they should do, and this pushes asset prices up, which they're very happy at, because when asset prices go higher, politicians get to take the credit, tax revenue goes up, everybody's happy. But when they go up too much, you start getting inflation, other bad things, everyone gets worried. So then they try to constrain the bubble. So they raise rates to try to keep it from going higher, take away the punch bowl. That's what they say. And what they don't realize, of course, that they're not dealing with a thermostat. They're dealing with a dynamic system. And so they did this in 1920. They raised rates to constrain the bubble that came out of World War I. And what happened was that the market didn't modulate or stop going up slowly or go down slowly. It crashed. Well, the same thing happened in the 20s. There were 3 rounds of quantitative easing in the 1920s to keep the market from crashing. And then in 28, 29, when the market went absolutely crazy, the Fed raised rates for the specific purpose of reining the markets to keep them from going up more. And instead, of course, they went down 90%. That wasn't part of the plan. The plan was to keep them even, not to make them go down, but that's what happened. And the same thing happened in the late 60s into the 70s in an inflationary basis. And then we saw this exact same thing in the 90s when Greenspan in the late 90s tried to raise rates to constrain the internet bubble. And again, the bubble didn't modulate or slowly deflate. It one day just simply crashed. And it happened again in the housing market. Bernanke started raising rates, I think in 2004 it was, for 3 years. And as he increased rates, the market bubble didn't care at all, until all of a sudden one day it did care a lot. And that's where I see we are now. The Fed's been raising rates slowly, very cautiously for 20 months. The market doesn't care. There's more room to raise it more. But at some point, it'll raise it to a level that knocks the cash flow, knocks the legs out of the credit structure, and then it comes tumbling down. And they can't lower rates 1 or 2% to stabilize things. They'll have to have QE at a order of magnitude larger than they did last time. And I think that is when we're on the cusp of that happening. And when that happens this time, I think gold's going to go up a lot further and a lot faster than most market participants think is possible.
We've got the CEO of Goldman Sachs, Lloyd Blankfein, and also the CEO of Deutsche Bank, warning that the asset prices have gone up too much too quickly. Basically, like there's been no normal corrections like there have been in markets of the past. The Deutsche Bank CEO said that there's inflation appearing in areas of the credit markets and other asset prices that capital structure that he would have thought there wouldn't have been any inflation. But you mentioned fractional reserve banking. Obviously, that's a money multiplier. There was the free banking era that Murray Rothbard wrote about. Do you think then that if there wasn't, I think what has happened with this system, it's perverse, where the banks in the past with free banking, if they would have done fractional reserve banking, they know, and there was no bailouts, and there would have been bankruptcies, and if the executives of the banks or mid-level employees like at Wells Fargo would have committed fraud in the past, those guys would have went to prison, and then the banks would have went bankrupt, and the assets would have been sold off. We don't have any of this now, and I think a lot of it, besides the rule of law and the Department of Justice not being willing to prosecute bankers for fraud, the other part of this equation, Dan, in my opinion, is that the central banks have basically the put. The Greenspan put, then the Bernanke put. Seems like all the central bankers are putting puts underneath this market. And so there's moral hazard in the system where a lot of people think, okay, we can do this fractional reserve banking, and, we're too big to fail now, so the central bankers aren't going to let this fail. What's your opinion on that then?
Well, no, that's right, and I don't think you need to prosecute them. The point is the market is regulatory enough. Up until the late 19th century in England, if a bank went down, the bankers lost their houses. I mean, they were personally liable for the debts, and that severely constrains your risk-taking of appetite when you yourself and your own personal assets on the line. I was reading about the Scottish banking system in the 18th century, and what struck my attention was that there was a badly capitalized bank that engaged in fracture process and over lent against bad assets, and there was a panic, and all the backers of this bank were dukes and lords and all these important people, and guess what? They had to pay up. A lot of them went bankrupt. I mean, big important lords and ladies. And here we are, we think, you imagine 21st century America, that this, a feudal system with lords and ladies seems so anachronistic. But guess what? When our banks collapsed, what happened? All the people who ran these things, who should have gone broke, they still have their mansions, they still have their huge bank accounts, they were bailed out, and they're richer than ever. And so, it's sort of strange imagination to imagine that the society we live in now is less egalitarian than 18th century Scotland was. But that is, in fact, what the central banks have done. That is part of how they've manipulated not just the economy, politics, and money as well. So I absolutely agree with you that in my view, a truly free market bank system actually doesn't allow fractional banking, because what happens is something called the law of reflux. If a bank that has to convert its notes on demand overissues its notes, the notes fall in value in the market, and speculators buy them up and show it back at the bank and say, "Hey, redeem these notes you've issued," and then the capital actually goes away, leaves the bank, and what short circuits that process, that natural regulatory process called the law of reflux, is when the state accepts the liabilities of its own banking system at par in the payment of taxes. Right? Because then what happens is when the notes devalue, instead of going to the bank and saying, "Hey, give me my gold for these notes," you can use them at par in payment of taxes, and that means you can spend the market. Everyone knows that they can pass them on to the government instead, and that really is, in my view, is what is the real support that the government, that the state lends to these banks that pretend to be in a free market, but they're not at all. They're in a protected, subsidized market. It's not just that you need to go through huge hurdles to get your banking license. It's that once you do that, your liabilities are supported by the state. The state does this for a very specific reason, which is that the banks support government spending. So the big banks, big government, big business, big academia, they're all in bed together. Often I hear these left-wing people, socialists, think that somehow business and government are in opposition. They're not. What's in opposition to the big business and big government are little businesses and individuals, craftsmen against big, giant structures. And unfortunately, that is, to me, is where the political divide should be. It isn't, but that's where it should be. And it's the Federal Reserve policies, the central banking policies, the government policies that have created all these problems and elevated it to a level which, again, in my view, is very, very dangerous, not just to the market and the economy, but to the very political structure, fabric of this country.
Amen. Yeah, and the large banks are basically a government-protected cartel. So, they're not going to get prosecuted at this point, and they get paid exorbitant amounts of bonuses, even if their company gets fined $1 billion for rigging, this market or that market or that market, when, in the past they would have been prosecuted for fraud or other things. But yeah, I didn't do a good job of explaining what Murray Rothbard wrote about the free banking era. You mentioned it in more detail, but the free banking era was okay. In the free banking era, when the central banks weren't big or weren't even there in the United States, the Federal Reserve hadn't been passed yet. If you were a small bank doing fractional reserve banking, your depositors were aware that the bank was going to take higher risk with the depositor capital, so you were going to be offered a higher interest rate. But what stopped these things from going crazy was, the people just pulled out the money. There was bank runs. So this was healthy. And so, if people realized that the bank was making bad loans and they had read in the paper that the bank had exposure to, this part of the market, like, I don't know, for, tractors or something, some type of farm equipment or something, and they had given out too much loans, and then the commodity prices of farms of food had dropped, and then so that people would go on a bank run and pull the money out of the bank before the bank went bust. So that was pretty healthy, but, the panic of 1907, that was the excuse that they needed to start the Federal Reserve pass. And I think, a lot of problems, the Federal Reserve has just keep consolidating more and more power. And then since the 1970, really, when the last vestiges of the gold standard, things have just exploded. I started looking up like history of bailouts, and you could just see the amount of bailouts stand going exponential since 1970. So I think it was a railroad for $1 billion. It was the first U.S. bailout. 1970 or 71 was the first bailout, and then after that, it just started to go exponential after that, up until the present time.
No, that's right. I mean, there's a quotation by Hayek, which I don't have memorized in detail. It basically said in the 70s, he said that he hadn't imagined how long the bubble could go, the bubble basically having started in Bretton Woods, but that it was because since we were no longer on a legislated gold standard, it could go much further than it had before, and he hadn't taken into account. But he said, of course, the dynamics are no different, and the ending will be the same as it always is. And the only comment I would add to that in our particular bubble is that, as you say, the central banks are more powerful than they ever have been, not just in this country, but globally. And so they've been able to push this thing further and higher than ever before in history. And all that means, of course, is that the adjustment will be that much worse. And I mean, this is it's not just theory. If you look back through, again, thousands of years of history, you see the same story over and over again of people who hubristically think that somehow they have overcome economic laws, and then eventually the laws catch up with them. And I think we're not far from that episode. It's hard to get the timing exactly right, but with the Fed tightening, it's not far off because, again, as Mises and Rothbard wrote about, when the economy is living on artificial capital, you have to keep increasing the pace. You accelerate the pace of money printing just to keep things stable. And so if you start actually contracting the money supply, which is how you rate, which is the effect of raising rates, then the collapse can't be that far off.
Since you've studied so much history, I want to ask you then, the George Santayana quote, those who don't learn from history are doomed to repeat it. I think most people don't even study history, but I think the only lesson from history in actuality is that most people don't learn from history.
Well, that's right. Cicero said that those who don't learn from history remain always a child, and I like that version as well. I think he was actually quoting an Egyptian from about 1,000 years earlier, that the Greeks didn't know their history and therefore were like children. So no, you're absolutely right. And one of the things about studying credit bubbles is I think it was Mark Twain, his attributor, was saying that history doesn't repeat, it rhymes. In this case, it repeats like almost exactly. And part of the book I'm writing, I try to bring it alive, is to resurrect these quotations from people decades or centuries ago, and just to show how similar the words spoken are in the modern day, in our current time, in the journal and other places, and what people wrote hundreds of years ago. And you read this stuff side by side, and it's exactly the same. And again, it goes to again, to me, what got me interested in this topic originally was not just some dry theory, but the actual experience, and looking at the experience of other people's in the past. And really, I think knowledge is best pass through stories. That's why the Bible is a series of stories. It's not thousands of pages of rules. It's stories living through these things, and that is how the best way to transmit knowledge. And I think that's been a little lost when the scientists have taken over economics and the math. One of the fun things about reading economic history is certainly through the 1890s, economics was considered a humanity. And so they did look at history, and they thought about human nature and human actions in that sense. And so it's a joy to read. It's fun. Of course, nobody can read economics written in a day because it's all math, and it's done that intentionally to keep laymen from intruding on the sphere of these professionals who, of course, get it wrong. Again, I was very amused by a speech Janet Yellen gave recently, where she said that the Fed's been great. They've learned so much. They learned how to bail out the economy in '87, and they learned about the the savings loan crisis, and then they fixed the internet bubble, and then the housing bubble. They used their tools. It's like these things are getting worse and worse and worse. And the way she views the world, the Fed keeps getting better because it keeps meeting these ever greater challenges. Like, no, guys, the challenge is getting worse and worse because you guys are preventing the system from liquidating. So, I mean, these people truly haven't even studied history, much less not learned from it. And that's why we're, I think, in the predicament we're in.
Amen. And, I think in the near future, I think the writing is on the wall. Stanley Fischer is leaving early from his he's the vice president on the Federal Reserve Board of Governors, I think second behind Janet Yellen. I think Janet Yellen may actually leave her job as head of the Federal Reserve. She can leave in her term expires in February 2018. I think she's probably gone a month later in March. Why stick around and risk being the bag holder, Dan, when she can do what Ben Bernanke and Alan Greenspan have done, charge $50,000 or $100,000 per speech, write a book about how mean Trump was to her, and then go and get like consulting gigs like what Bernanke is getting at hedge funds for 6 or 7 figures a year.
It's
So
amazing. It's amazing people pay these people this much money. But I think it was Nassim Taleb who identified as the pre-bribe. Did you read his theory on this? Which is
no.
you can't send Janet Yellen a check today because that's illegal and she can't do that. What you can do is you can give her millions of dollars when she leaves as a signal to the next guy that if he plays ball, he'll make millions when he leaves. So it's like you're bribing the previous person to influence the behavior of the current person. And I think it's a great theory. I mean, it seems to work. There's no other reason why you would pay these turkeys tens of thousands of dollars to give you some points that are not profound and have no forecasting ability whatsoever. And they have no influence at the moment. So why do they pay this money? And the answer is to influence the current people.
And that's a good point you brought up. The one thing that I don't hear a lot of people talk about is the track record of all these Keynesians making models, and their predictions are almost entirely wrong. Janet Yellen was the San Francisco Federal Reserve president, and she had no clue the housing bubble was going on around her 2007, 8, and 9. She had no clue.
Yeah, but it's worse than that, because she had no clue, and she gave speeches saying there's no clue. And the New York Times, when they endorsed her candidacy for chairman of the Federal Reserve, trumpeted how she had warned about the housing bubble. And there was some line that they truncated that she said, yeah, housing prices look high, but the rest of the sentence was, but there's no danger and there's no problem. and so it's not that she got it wrong, it's that these people cover for themselves and they invent this history. It really is straight propaganda. This is not even, it doesn't pretend to be news. It's just propaganda. I think it's quite frightening.
And I think, in actuality, they realize that they've made, the asset markets artificial, and that they've, propped things up, that the reality is there hasn't been a real economic recovery. There hasn't been job creation and value added and more productive economy with, new goods and services and higher paying jobs. So when they say, I think there's real inflation in the economy, but I don't think it's because demand is increasing, and I don't think it's because wages growing. I think it's basically stagflation, because the longer Keynesian economics is implemented, the more misallocation of capital there is with money and credit in the system, and that leads to stagflation. So I think we're going to have stagflation. Do you think, though, that Donald Trump is probably the perfect bag holder for all this? Because look, because remember, he was running on rhetoric during the campaign that Janet Yellen's created all these bubbles. She's artificially manipulated interest rates lower. He was saying things that the average guy on Main Street was kind of thinking like, well, I don't own that many stocks, and stock market's going up, and it doesn't make much sense. So it sounded to me like he understood the right rhetoric to say to get elected, and now here he is taking credit for the stock market going higher since he won the election.
What a disappointment. I mean, sometimes you read sort of declining empire, some emperor shows up and kind of shakes things up and, buys an extra 50 years or something like that. And that was his potential, right? We should take this swamp, this corruption on both sides of the aisle, this corporatist nexus, academia, the whole thing, and really clean it out in a healthy populist movement. Populist movements can be very bad at the French Revolution, but they can also be very good. And keep things in even keel, and that was his potential. And I mean, I like to say, I voted against Hillary Clinton because I didn't want Goldman Sachs running domestic policy and neocons running foreign policy, and so Trump won, and that's what he's doing. I mean, maybe he got rid of some, transgender bathrooms, I mean, whatever. But the real meat of governance is in the same hands it was under Obama and under Bush. It's just extraordinary. So no, he's been a complete disappointment, and I do think that he is a great bag holder for this market when it collapses. And it is curious because he seemed to get it. I agree with you on the campaign trail when he was talking about interest rates in relation to the market. And now he owns it. I mean, he's out there every time the market makes a new high. He says, "Isn't this great? It's my doing," and so on and so forth. So he owns the market now, and I just don't know what his strategy is when it collapses. Although, again, I will say that he's put Goldman Sachs in charge of the economy again, and whatever happens, they'll make sure that Goldman winds up on top, and everyone else gets screwed. So I mean that I think is in the works. So though again, last cycle, people who owned gold going into it and coming out of it did very well despite the bankers. So I do think that the free market wins in the end. That is one of the also core lessons of history, is that yes, politicians can resist the market and they can push back at a certain level, but eventually the market overcomes political power, and it will in our case too.
I don't think Donald Trump has really that much of a strategy. I think, he's more of a pragmatist. He's not an ideologue. So he's willing to make deals with any side as long as he gets something accomplished, whatever, he views as worthwhile.
But he's
So
not even that. He's not even that. Let me jump in because, one of the problems is that Obama did, that Bush didn't, is when you become president, the federal government is this huge morass of people, of workers. And what you have to do, day one, is fire everybody you can and then put your own people in. If no one's in the seat for a while, so what? Nothing happens. Who cares? And what happened with both Bush and Trump is that they didn't hire people fast enough, and they let the Obama guys stay there. And there's some of them are still there. It's absolutely incredible. And so maybe he gets the number one guy in eventually, months later, but the number two guy isn't there. He hasn't been appointed yet. The number three guy is actually running the show. And the number three guy is some career Obama appointee who's undermining the whole schedule. So he's not even being practically effective. I mean, his promise was he was this big businessman and can-do guy, and he was going to, take that attitude of
he was going to run the government like
right.
an efficient business. Yeah,
exactly.
He was going to restructure the government.
Right.
So if he was running a real estate business or another business that he owned and he wanted to turn it around, he could fire everyone real quickly.
Exactly.
And in a couple years, he would start seeing good results. But that's just not how the government works. I mean, the government spending, Dan, I've lived outside of Washington, D.C. since the year 2000. So, I have good connections here. And basically, the government spending for 5 years in advance, 80% of the government's budget is locked in. And, the firing people, in theory, that sounds great. I would love to see almost everyone fired here, but you can't do that.
Oh, I know you can't up to a certain level. You can fire the top people because they're your appointees. And the point is, he hasn't fired the people he can fire, and he hasn't. There's huge numbers of positions he hasn't filled yet. And so when you don't fill the political position, it means the career guy gets to make the choices. So that's the problem.
He wants to hire people, but things are getting blocked. So there's literally both political parties. The Republicans hate him. So you have a lot of normal, regular Republicans, because I wouldn't consider Trump a Republican. I would consider him an independent who used the Republican ticket to get elected. And so there's still a lot of Republicans who are very jealous and resentful of him because of that, and they basically, almost all the Republicans hate him because of this. So they don't want to, they don't want to do any compromises. They don't want to work with him. They might say in public, like Paul Ryan, that they do, but in actuality, behind closed doors, in my opinion, a lot of them are more like John McCain. And John McCain absolutely hates Trump. He'll do anything he can to slow him down or sabotage him. And that's why, a lot of those appointees, it's not only Republican senators that are blocking it, it's, the bureaucrats, the Office of Management and Personnel, that they're not approving any of the Trump people who he wants to bring in. So and the Senate confirmation hearings, it's a disaster. It's extremely dysfunctional at this point. And like you said, he has a lot of his advisors are either hardcore Democrat, Goldman Sachs people, globalists, who want, what Hillary Clinton said in her speech to Goldman Sachs with open borders and all this crap. And then the military-industrial complex. He's taking orders from 3 generals who are, making big payroll money from military-industrial complex, and they're warmongers. One of them, McMaster, even wrote a book about how LBJ could have won the Vietnam War if he would have increased the troops even more and not ignored his generals.
Yeah, I agree.
Yeah, so I think unfortunately, we got this neocon foreign policy increasing. So it looks like North Korea. I don't blame Trump for everything for North Korea, because obviously Obama ignored it for a while and things were getting worse. And then Bill Clinton, gave them all that money, and I think I saw on video that he even handed them over like nuclear power stuff a long time ago. So I mean, this has been a festering problem. But you have Venezuela potentially with the neocons and getting intervention. So I don't think he's gonna. I don't think he's going to be able to fix any of the stuff, but it's because D.C. is entrenched. So, all these change candidates come here to D.C., Dan, and whether it's Congress, the House of Representatives, the Senate, or President, and they can't do any change. So, and it's because of all the people here in D.C., whether it's the lobbyists, the bureaucrats, whoever, they don't really want change. They want to make their big bucks with the status quo.
Yeah, I agree, and the implication, of course, is that at some point the market will defund these activities. You can't project power. You can't spend so much money on your military if the economy is not functioning. That's what supports this whole apparatus and welfare payments and so on and so forth. And so what will happen is you'll have a sudden collapse of the structure as opposed to a gradual decline. And that is, again, a frightening prospect. But yeah, it's one that I think is very, very clear. Again, if you read history, that this is one of the ways empires go. And certainly the Soviet Union went this way. The economy simply didn't support the apparatus, and one day just ended. And it would be, I think, unfortunate that happened to us, but I don't see a different outcome given the trends that are in place and seem to be irreversible.
Well, the Soviet Union didn't have, all these productive corporations and entrepreneurship that that the United States still has, in spite of all these hurdles. And also, the United States has a world reserve currency and the petrodollar for now, although that could change
for now
in the near future. So as long as the U.S. has that, right now the U.S. is able to export so many treasuries and dollars out of the country, and that other countries are holding them, that they can basically inflate the dollar almost as much as they want. And other countries will still take dollars and treasuries. And a lot of it has to do with the military. But I want to ask you, so obviously I think people should have some gold in their portfolio. What got you interested in junior mining stocks when there's other safer ways to either hold gold for wealth preservation or insurance, or royalty and streaming companies that can generate free cash flow? Why did you pick junior miners instead?
Yeah, well, I don't view the gold positions either or. I think there's a room in a portfolio for both, and frankly I think that one's bullion position should be a lot larger than one's junior mining position. What got me interested in that spectrum specifically, it was my time in Argentina, where I saw firsthand what happens to the marginal asset when a commodity moves. I mean, it's easy to say in theory, but it's actually true, and dramatically so. That again, I don't know if you're talking iron ore or cattle prices or whatever it is, a submarginal assets that have no value at a certain price level start to have some value at a higher price level. And so going from zero to something can be an infinite percent increase, or I mean, not infinite, but a big one. And so I saw in Argentina when I was there, all these base metal beach properties, whatever they might be, going up 10, 20x in a few years. And of course, they went right back down again when the crash came. So it's a two-sided sword. But so if you like gold, and what I look at specifically isn't gold so much in nominal terms as the gold commodity ratio. Gold always underperforms commodities during a boom, which shrinks gold mining margins in terms of gold during the boom, and then vice versa in the bust. That's why gold miners generally do so well in a big credit bust like the 30s, like the 70s. And so having developed that thesis, I thought, well, what's the best, most efficient way to play it? And the answer is in marginal gold mining deposits and operations. Marginal doesn't mean crappy; it just means marginal. And so the way I look at the world is, gold is going to 10,000, and that's a number I can defend. But it might go to 800 first, and so I like to have investments that have convexity to the upside, but have some resilience to the downside, and that's how I evaluate these things. But you can make, if you get the timing right, extraordinary amounts of money in the junior mining sector. Again, there are times when these things can go up 30, 50x, right? But you take a lot of risk doing that. And if you have the bullion, the point of bullion is to stabilize your purchasing power. That's his point. If you look at commodity prices in terms of gold, it squelches their volatility. For example, the monthly standard deviation in oil prices in terms of dollars since 1970, since Nixon took us off the gold standard, is about 64%. The standard deviation of oil in terms of gold is 40%. So you get a clear picture of what's happening to prices when you look at things through gold. So what that implies is you're not going to make 10, 20 extra purchasing power in gold bullion, but you're also not going to take huge losses. So it's a great place, gold bullion is, to lock in your purchasing power in whatever comes down the pike. But if you want to have a little bit of insurance, and I mean, I think it makes sense to balance your other investments, your pension, your house, your stocks, whatever it is, then I think a little bit of capital in the junior gold mining sector can really provide that juice to make up for your losses that you might experience in your general assets when the big crash comes.
I think that's the key. What you just said is a little bit of your capital is even fun to speculate with. A lot of people like speculating, but I think the mistake that a lot of people made who either they thought they were investing in gold and silver miners is they put way too much of their capital into juniors. So, they maybe saw a YouTube video promoting a junior mining stock that had a lot of views on it, and they said, oh, this company must be good if they're paying to run ads. And so a lot of people get sucked up in let's say marketing garbage from Vancouver, from Vancouver with bad juniors. So there's a lot of marketing problems with these juniors, and there's a lot of retail people, who don't have a financial background, can't read a balance sheet, can't tell the cash burn ratio of the junior, they don't have a geology background, they don't know how to read drill hole results, and they put a lot of their potential capital into juniors. So you're a hedge fund manager. Do you look at the geology reports? Do you hire a geologist? Can you just talk about some of the risks then that people should look at to protect themselves?
Yeah, I think the junior gold mining sector is characterized by very, very poor management. And so you have this tension, this problem where you can have decent assets run by people who really shouldn't be running them. But there's so many different little tiny companies, it's hard to attract good talent to these small operations. So one of the biggest challenges is finding managers. And the saying in the industry that you'd rather have a good jockey than the horse in this case. I mean, ideally you have both. But a good project run by bad managers isn't going to go anywhere. So management is key. What their experiences are, who they are they honest or not? I found a book called "Fleecing the Lamb" about the Vancouver Stock Exchange. I think it was written in the mid '80s. Looking at the history of it going back 100 years or when it was founded in, I think, the early 1900s. And the number of scams in the book that I was familiar with over the last 5 years is sort of incredible. The same scams come again and again. And the point is that this, the fleecing the lamb, of course, the lamb being the retail investor, it is a Shark Tank out there for these properties. And the reason capital keeps coming back for more is because the ones that work so well and are so dramatic that it encourages the others. So I think even more important than the geology and the balance sheet, all the things you say, all of which are important, it really comes down to management and being able to trust management. But to answer your question, I'm sort of a high level guy in terms of the strategy. I employ analysts who do know the geology and look at it for me and give me a sort of fatal flaw analysis for the different things I look at. But again, my criteria, what it boils down to is this project going to respond to gold prices in broader terms? So I avoid greenfields exploration because you know what? There's no gold there. I don't care where gold goes. These things can go to zero. So I don't like that because I'm not looking for geological risk. I'm looking for gold price risk. But does it have the resilience either through its balance sheet or its cost or whatever it might be to survive a big trip to the downside? That doesn't mean the stock won't go down if gold gets hit when the next crash comes initially, which is certainly possible. But I just want to make sure that the company I'm investing in will maintain its ownership of its asset. It's not going to default on some loan or have some distress where it loses claim on the asset. Because then, if that happens, when gold comes back, you're still left out in the cold. So again, resilience to me is sort of key for the investment decision, and it keeps you out of the really speculative ones, which might even do better, right? If we don't crash first and gold goes straight up, which I think is also very possible, then the more shaky ones will actually outperform. But you're taking a lot more risk that you don't need to take. So I try to get rid of that risk.
Yeah, Doug Casey says when the wind is blowing hard enough, even turkeys can fly. And Doug Casey actually made, I believe, around $1 billion speculating on Briax. He actually bought a private placement in that, and he didn't know it was a fraud. It went from, I think he bought in on the private placement from 10 cents, and it went up to $150, and he had so much money locked up in the stock, he sold out, got out before the fraud. But I think, there's the fictional book there's the Gold movie with Matthew McConaughey, which is actually a good movie, but it didn't do well in the movie theaters. And then Doug Casey wrote a fictional book about it last year called Speculator, which is another great book. But I think, the Canadian industry, when they put out the NI 43-101, I don't know how accurate those things are in actuality, because there's a lot of, from talking with people who look at these reports a lot and whether or not to make investments into them, like a Sandstorm Gold, that there's a lot of let's say optimistic assumptions put into a lot of these models. So almost when you compound, so it's like garbage in, garbage out with a lot of these predictive modeling, whether it's the Federal Reserve or other models that similar type of mathematics in there. And so when you start compounding fundamental assumption after fundamental assumption after fundamental assumption into the data, then your end result is not a realistic assumption then. So I think that's what the junior industry, even though there's NI 430101 and these other things that are supposed to protect investors, I don't think in actuality they're really helping as much as they could at this point.
Well, I'd push back a little bit. I don't think it's quite fair to compare crooked geologists with essential bankers. But so you say is garbage in, garbage out. That is true. And then again, that goes to I don't think the methodology is flawed so much as again who are you working with. All these parameters, as you say, can be tweaked. So if you just pick the report up and read it on its own with no context, it has almost no value. But if you use it as a baseline. To think about who wrote the report, what what is the reputation, and then go through it with management to find out what does it really say and what are the parameters that you're dealing with. I've only had a few people actually straight out lie to me in a meeting. I mean, they might try to present the best light on things, and that's natural. There's nothing wrong with that. But most of them don't just lie to you with your face. So if you probe into some of these questions in terms of, again, what are the stress levels and what are the parameters, you generally get a pretty clear answer. And then you can make your own decision of how much risk you're comfortable with. And it also goes to, I think, the way I approach it too, which is having a pretty large portfolio because there's enormous volatility in the space. If you the gold prices, even with operationally, whether it's drill holes or operations or grade in the performance or, whatever it might be, unlike the broader markets, you really need a pretty broad portfolio to try to diversify out that volatility and that risk.
Well, there's the new ETFs now. So the GDXJ, which isn't really juniors anymore, but you have the new Sprott Junior Gold Miners ETF, which is a pretty good ETF. But yeah, it's kind of the shotgun approach of buying all these junior miners. Diversification is important, but I think another mistake that a lot of retail investors make, Dan, is that they tend to hear a good story from a well-marketed junior, and then instead of being diversified, like you say, with these juniors, they tend to put all of their money, all of their capital that they plan for speculation into only one or two.
Yeah, well, that's what I mean. Yeah, exactly. That's a very non-optimal way to approach the sector, I think.
My favorite way, I'm not sure if you're familiar with the company, but my favorite way to actually play juniors is with Sandstorm Gold, because they do royalty and streaming, but then they have two full-time paid geologists on staff with around 40 years of experience each that have found mines all over the world. And so they, buy royalties on good properties that their geologists have looked at for $500,000 or $1 million. And sometimes, these things will pay off in the long run. So, it could turn into a mine and generate cash flow that way. So they have good exposure to the juniors, but it's also, a cash flow company with no debt and a good balance sheet. And you get that junior exposure that way. So my returns are probably not going to be as high as yours. If the junior finds a new gold mine or the gold price goes high like crazy, but my downside's probably a little bit more protected because Sandstorm Gold, can afford to lose $1 million on a bad royalty deal with a junior because they have a lot of cash flow coming in from their other royalties and streams already online.
Mm-hmm. Yeah, I don't usually comment on specific companies, but I would point out that the royalty market got very hot, and one of the reasons is that, again, I think the royalty companies took advantage of the fact that many of the management teams in the juniors weren't very financially sophisticated. So the way they priced these royalties when they bought them were very much undervalued, and so the royalty companies had big windfall gains because of that. The market's woken up to the management have woken up to this, and so I think it'd be tougher sledding going forward for the royalty companies because people are aware of what the valuations should be, and the royalties got pretty rich compared to the valuation of the actual operating mine. So you're right. It probably has less volatility. I haven't looked at it. It's certainly possible, but in terms of where the compelling valuations are, it hasn't been the royalty space for a while. But again, it depends on your risk reward appetite.
Yeah, and the royalty companies are also countercyclical. So they actually, unless their balance sheets are totally screwed up, they actually have cash. So when the juniors, like you said, the juniors, some of them may have known the value, they were getting a bad deal or valuations were bad, but they needed the cash to keep their business running or to do a drill program. And the royalty and streaming companies were some of the only people with the capital willing to give them the capital. So that's why you get, in the bear market, that's why you get where Franco-Nevada buys for $80 million. They buy a 50% life of mine on a producing gold mine from Coeur d'Alene. On a producing silver mine, they get 50% life of mine of all the gold at the Palmarejo mine. Or Sandstorm Gold gets for $500,000, they get a royalty that's probably worth a couple years later 10 or 15 million from a junior in Mongolia that looks like they're going to have a big gold mine. So, there's kind of a give off there, but it's an interesting space. It's definitely exciting. So
yes.
You're going to... Yes, it's one of the most other than maybe biotech stocks and what's going on with cryptocurrency with Bitcoin and these initial coin offerings. The junior gold mining space is very exciting.
I agree.
Well, I enjoyed our discussion today, Dan. Actually, I would love to have you back on to talk more about history. And you can definitely promote your book when it comes back, when you're done with your book, and you can come back and talk about your book. So that would be great as well.
I'll look forward to it. Thanks for having me on. Appreciate it.
And if our listeners want to follow more of your work, how did they do so?
Just go to my website, murmurcon.com, and all my letters are posted there. And that's I generally put my radio interviews up there as well. But that's the best way to follow what I'm doing.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube /Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.